Hey, what's up, boys and girls? Jason here, Money Success and Happiness channel. And today, what I'm going to do is I'm just going to make a real quick video, and I'm going to teach you guys how to analyze a stock the quick and easy way and efficient way. A lot of people, there's videos online, and they'll try to show you how to analyze a stock, and they'll say, "Oh yeah, it's the easy way," and then they go into all these confusing, complicated, ways to analyze a stock that you basically need a business degree or be a CPA to understand. And to the average investor, just the average working man that just wants a quick and easy way to see if stock is worth putting their money into, they don't want to have to deal with all that stuff, a bunch of math equations and stuff like that. So I've seen a lot of videos on here, and I really didn't like them, so I'm going to show you guys the easy way to analyze a stock. I have 6 steps, and this basically will give you a lot of information, and this has been working out good for me, so you guys can try it out. And this is what we're going to use today. We're going to use Yahoo Finance, the app. You can go to the website too, but this is the actual app. I use the app mostly, so it's real easy, and you can find it in the Play Store, no problem. And so we're in the front page right now. This is a couple of my holdings I have. This is like my top 5 holdings that I have, and I have these favorited. And what we're going to do today is we're just going to go into one of these. Let's go into Facebook, and I'm going to show you how to quickly and easily analyze a stock. So let's first click Facebook right here. Okay, now we're in Facebook right here. You see the ticker symbol is FB, currently trading at $245.07. And the very first thing to do is just look at the chart. I say the chart tells you about half of the information you need. The chart is really important. If you just really analyze the previous performance, the past performance of the stock, you're going to find out a lot of information just from these charts. Now, the first thing you can see is it's like gradually just going straight up. You see there's been a couple dips in there, but you can see a nice pattern of progression of accelerating upward. Okay, there's like almost a perfect incline, which that's a great sign. I have this on max right now, so this is from its inception date. Looks like it was around 2010 or so, maybe around there, and it's all the way to 2020. This is about 10 years of performance. So you can also go to the 5-year. Looks pretty similar. Okay, and go to the 1 year. You see that big dip right there? That's our little friendly virus right there that did that big dip. You see it's recovered quite nicely, and it's at all-time highs right now. And you can see that little dip here. I'll go a little closer. 6 months. You see a little dip. That's that little bad news they had with Facebook, with the different companies pulling their advertising. So it kind of tells a story when you're looking at this. You can, especially if you've been in the stock for a while, or you've been following it, you can kind of see all the little you can look at these dips, and they all tell a little story. And also when it goes up, tells a story too. And then you got 6 months, and then you got 3 months, you got 5 days. This like the 5 days and the 1 day, those are kind of less important because they're not a big enough time frame to really give you a bigger picture. But I'd say anything like 3 months to max will tell you a lot. And it also tells you like the percentage it went up, and it has a trend line right there for you. So there you go. That tells you a lot of information. So that's the first thing you should look for, is just to see if you see a stock that's steadily been going down, or if it's had like trouble in the past where it's gone really high and gone lower and gone really high and gone low. It's kind of a warning sign. I usually try to look for stocks like this that are just basically going straight up. So if I see a chart like this right away, I'm like, okay, that's about 50% of it is just to see a nice ascending pattern of a stock over the years. Of course there's like little couple of dips, but that doesn't really matter because things happen. the coronavirus, that every stock got hit in that, so you can't really like judge it by that. So, but you see, it looks like it's got a nice progression upwards. Okay, so that's the first thing. That's number one. So now let's go to number two, is the beta down here. See this beta right here? It's 1.20. So what that means is the larger the number of the beta, it means that it does well when the economy is doing good. Okay, so if it's a high number, that means it does good when the economy is strong. And if it's a smaller number, that means that it does well when the economy is doing bad. Okay, so depending on how you're investing, that 1.2 is about average. So depending on the circumstances, it can give you information as if it does well if the economy is doing well, or if it does well when the economy is bad. So that's the second thing. That's real easy. And then thirdly, let's go to the market cap. Okay, the market cap's important. So where's the market cap on here? Let's see. There it is right here. Okay, you see it? It's like right in the middle. It's almost $700 billion. Okay, it's gonna be $1 trillion before we know it. That's the way it's going right now. So what you can do is you could look at the market cap to see how big it is. Obviously, we know Facebook is one of the biggest companies in the world, but what you can do with that is you can compare it to other companies that are kind of like in the same field, so like in the same industry. So like we can go back and we could let's search another social media site, like Twitter. Okay, so here's Twitter. So then you can compare it. So you look at the chart on Twitter, it's not as pretty. Anyways, so see the market cap on Twitter is only 27 billion. So obviously it's like a dwarf compared to Facebook. So you can look at several different ones, and that'll kind of give you an idea of where that company stands in the size. Like if it's one of the top. I myself like large cap companies, or mega cap. Like a Facebook would be considered like a mega cap company because it's just so large. Because me personally, I feel safer if my money's in a company that's massive, because I think there's a lot less chance that a company's going to go under or get taken out by another company. Like in Facebook's case, let's go back to Facebook. Like in Facebook's case, Facebook owns Facebook, and it also owns like Instagram, and I mean, it's just like the leader of social media. So I sleep better at night knowing my money is in something like this than something smaller. Don't get me wrong, I have some other smaller stocks too, but most of my money is invested in large cap, because I just feel that the large cap companies are basically going to dominate the market, and they have a lot more basically influence on the world than something smaller, because something smaller can get taken out easier by a larger company. That's just my thinking on it. Okay, and let's see. Okay, next let's go to the PE ratio. Now you see the PE ratio right here. See, it's right above the beta. Excuse me. And the PE ratio, now what that means is the PE ratio is 33. So with the PE ratio, the higher it is, that means the more forward looking they are. So it means that for every dollar you invest, okay, so it's 33 times. So you got to spend $33 for every dollar they make. So the larger the PE ratio, that means the more forward looking the company is. And if the P ratio is really large, it's a little bit higher risk, because if there's like bad news in the market or anything like that, then basically it could go down faster. Okay, and if the P ratio is really low, then that means a company could be undervalued. Okay, so, but there could be a reason it's undervalued too, because you never know what's surrounding the company. A company might be undervalued, but people don't really like the stock. To be honest with you, stocks are kind of like popularity contests. I mean, obviously, the company has to be doing well and making a lot of money and all that, but it's really like popularity, because like some stocks are like sexy, some stocks aren't, or they're not trending, they're not in style, so sometimes you'll have companies that have massive PE ratios because they're looking way out of the future, just because they're so hot and so popular, everybody loves them so much, they just keep dumping money into them, and people don't care how far out you're looking, they just they want a piece of it. So that happens all the time. And then you got other companies that are super undervalued, and they seem like a really good deal, but people just don't care. You're gonna probably lose money even though they're undervalued. People aren't always gonna care about what's undervalued or overvalued. A lot of, like I said, a lot of stuff in the stock world is just popularity. Whatever's popular at that moment, whatever's hot, whatever's trendy, that's what's gonna usually gonna have a lot of money into it. So you can't always think rationally. The stock market isn't rational. You gotta remember, the stock market is run by people, and people aren't always rational. Think about it like elections, or in school or something. It's not always the smartest person gets the job or gets picked or whatever. It's mostly the person that is more popular and everybody likes it. Everybody likes them or likes it. It's the same thing with the stock market. It's just how the world works. So you gotta remember that. So anyways, okay, let's move on to the next thing. So that's the PE ratio. So 33 isn't too bad. Some are a lot farther out than that. Let's go to the next one. And what's the next one here? I wrote a few down for you guys. Okay, so let's go to, I think it's in details. Here it is. Okay, so earnings. Let's go to earnings. So see, this shows you right here. So this shows you what the analysts thought they were going to make each quarter, and if they actually met expectations. As you can see, in quarter 2 of 2019, they didn't meet expectations, not at all. They were down quite a bit. In quarter 3 of 2019, they beat them. Quarter 4, they barely beat them. So this shows you, so everything's kind of priced in. These analysts price everything in, and they have expectations, and if they're missing expectations a lot in their earnings, that's a really bad sign, But if they're making them, or this doesn't look too bad, They beat them a couple times, and this, the quarter 1 of 2020 is barely missed expectations. So, they're progressing like they're supposed to, but if they're constantly every quarter missing expectations, missing, then that's kind of a bad sign, especially if it's going down more and more. So that means the company might be in trouble. So that's a quick thing to look at. This one looks decent. It's not too bad. So they can give you a lot of information. And now let's go back really quick. We can go to finances right here. So this is kind of cool. It tells you every year. So right now we have it in annual view. So it tells you the revenue and the earnings every year. So this is yearly view. So 16, 17, 18. Now you can see, look at how much the revenue's gone up every year. It's quite a bit, And we almost got 30 billion, then you got 40 billion, then you got 55 billion, and so on. If you don't know, the revenue is how much the total company makes, and the earnings is how much is left after everything else is paid for. So the earnings is your actual earnings, revenue is the total money that you made that year. So, and then you can also go into quarterly, and you can see the different quarters, how much they made. And see, quarter 1 of 2020, that's probably because of the whole thing we're going through right now. But you can see like especially on the yearly chart, is they're going up quite a bit. There's a lot of earnings, a lot of revenue progressively going up, each year. So that's a really good sign, and that's probably why the stock is doing so well. Okay, most of that is from ad revenue. Facebook and Google alike, they pretty much make all their money through ad revenue, which ad revenue is down a little bit right now. But the good thing about like Facebook and Google is their ad space is a lot cheaper than like television, radio. So a lot of companies, even in the epidemic going on, you're still going to get a lot of companies going to Facebook and Google because it's the price point is a lot cheaper than if they try to go to television or radio. So no matter what, even if a few companies are boycotting Facebook, that doesn't mean anything. There's like millions of companies that want to get ad space on there, so they're going to be just fine for sure. That's why the stock is still doing well. Not that many people care about the boycott. Anyways, I'm getting off topic. Anyway, one last thing too is honestly, I think a lot of the companies just want to save money, so they're using the boycott as an excuse to save money and save face, so they don't have to tell everybody their business is in trouble. Because if you really pay attention, a lot of the companies that are pulling their advertising are the ones that are really doing bad. Their stocks are doing bad right now, so it's a really good way to get a lot of free publicity. So I think that's a big part of it. I think there's more to it anyways. So okay, so back to our main point here. So we did earnings, okay. We did revenue. So let's see. I think that's about it, guys. I think we pretty much did everything. You can also look at the dividend too. This one doesn't have a dividend. Usually tech companies don't have a dividend. A dividend is how much they give you back in the stock each year. They usually pay it out quarterly. So if this said like 1, then however much money you have invested in the stock, you're going to get that much back each year. So if it's 1%, you're going to get 1% back of how much you have total each year. Dividends I'm really not a dividend investor. I'm more of a growth investor. I think you make a lot more money that way. Maybe someday when I'm a multi-millionaire, I'll be a dividend investor, but I believe in growth first. I think you make more money that way. So I hope this helped you guys out. Oh, here's another thing. One more thing. Let me throw this in as a bonus. Right here, see the analyst price targets? This is a cool thing too. This also helps you right here. If you look at the analyst right here, it tells you what they recommend. So this is a 1.8. That's really good. So it's a like strong buy. Okay, it's getting close to strong buy. It's between buy and strong buy, which that's a good sign. And then the price target right here. Okay, this will tell you like how much the price, the low end of the price and the high end of the price, and where it's currently at. So this will tell you. So if this is really, really high, that means you're kind of buying at the top. All this stuff you kind of have to take with a grain of salt, like the analyst stuff like this. But it gives you an idea. So this shows you the average price, the current price, and the high and the low. So that's a good thing to look at too, because you can kind of see like if it's on the high end, if it's a little overvalued, or if it's undervalued. So right now it's about average, which is cool. If it was really like check it out. Like if we go to something like Zoom, watch this. I think Zoom or Shopify, one of these has really high. Where is it again? Let's see. No, it's not this one. Maybe it's Shop. I remember I saw one that is like really off the charts. Let me see. Well, this one, see, like this kind of gives you, see, it's the average price is $793, and it's currently over $1,000. So it's getting really close to the high end. I thought I saw a different one that was even worse than that. But see, this one could, like, you see this, and it kind of gives you like a warning sign, like, oh, it's a little overvalued, so it might go higher. And I actually have both these companies still in my portfolio, and they seem to be growing. But it just kind of, you can use all this information and you just put it all together, and you think, okay, usually if it hits most of the marks, you have a good company. If like one thing's off or something, you don't have to worry too much. But if you see a lot of warning signs, then definitely be like, I don't know, maybe I should go to something else, put my money in something else. So, but if most of these things are hitting the marks or like, good signs, then yeah, go for it. Put your money in it if you feel confident. So I hope that helps everybody. It's the easy way to do it, and you don't have to be a math wizard to understand all this stuff. So let me know in the comments. Just let me know if this helped you guys, or if I missed anything, or you guys want to add anything, or just let me know what you think. And please like and subscribe to my channel, and just have a good night, and make a lot of money in the stock market. I want us all to make money out there, so make money with me, and anything I can do to help, let me know. Thanks. Later.